So it is Saturday, January 3rd, 2026, and I am here as always with my friend Pete. Pete, how you doing?
Well, Happy New Year,
Happy New Year to you, sir.
2026. Maybe I can give a little update in a minute after we make some chit chat, but I'm hanging in there.
Yeah, right on. Do you have you kids all head back to their respective cities, or are they still kicking around?
Mike's always here, but
Yeah.
Jack is still around. He's been here for a couple of weeks, and we're having a big birthday party for me on the 10th.
Okay.
Is the big 6-0.
The big 6-0.
Was one of my goals to make it to the big 6-0. I think I'm going to easily surpass that.
Heck yeah.
So that's good. And yeah, so he's got a lot of flexibility with his employer, which is great.
Yeah, that's nice.
So he may or may not go back next week, but he's coming back either way.
Sure.
Yeah.
That's great. I'm glad.
So let's see. There's good news and less good news. Maybe I'll start with the good news, which is, for whatever reason, in the last couple of weeks, my fatigue that has been like almost debilitating at times has abated. Like I haven't, like frequently, several days a week, I would get up, have breakfast, do the Wordle and the spelling bee and the New York Times, and then go back to bed. And I haven't had to do that for, I don't know, a couple of weeks. So that's good.
Yeah.
Um,
To what do you attribute that?
I don't know. They upped the dose on an antidepressant that I'm on, which is entirely feasible. I didn't feel like I was depressed, but the old not wanting to get out of bed
Sure.
is frequently a sign of depression.
Yeah.
I don't know if that's helping, or some other medication they have me on, or maybe who knows why something has changed. So that's good. I think you can hear my voice is a little weaker today. It's actually 2 days ago, I was talking to my brother, and he's like, "Wow, your voice sounds really strong, like sounds normal."
So it comes and goes.
Sort of goes back and forth. So I don't know why today is different than 2 days ago.
Sure.
But that doesn't really bother me that much, one way or the other. As long as I can make myself intelligible, that's really what matters.
Yes.
My left hand, or left arm, I should say, varies between extraordinarily difficult to not possible to touch my face.
Really?
To curl like that. My bicep is so weak that I can't really
raise your arm.
It's just super weak. So I certainly can't pick anything up with my left hand. But so that's an annoyance. What's less of an annoyance, or I should say much more of an annoyance, is my balance and walking has become way less, or way more unsteady.
Okay.
I say way less steady, but
yeah,
it's been unsteady for a while. But it's like I don't really get up and walk around the house without my little rollator walker thing.
Right.
And the reason for that is I've fallen down twice in the last 10 days. And that is not good, obviously.
Yeah.
One time I was trying to pick something up, and I was on my right knee was down and my left foot was up, like
like on one knee.
Yeah. And I fell backwards.
Huh.
I think that I didn't have the strength in my right leg, to provide that leverage to keeping me upright or something.
Huh.
So that was scary. And I knocked my head pretty hard on the wood floor. Got a little whiplash. So that got my attention. But what really got my attention was four of us, Lily and Jack and Lynn and I, were at the dinner table, and I stood up, and I think I just went to move my right foot a little bit, and it kind of caught. My foot's sort of sagging, and I went down like a tree. I mean, that was scary.
Oh no!
Like hit my hip on the wood floor, smashed my head pretty good again.
Yeah.
no ability to protect myself.
Sure. Sure. Right.
Uh, that got my attention, and so now I'm using the walker all the time because I'm,
Yeah. You can't afford to take the
you know,
risk and the
and like
beating.
if that happens, in the bathroom or something where these hard tiles are, or
Yeah.
any type of edges to the tub or whatever, then I get that
Yeah.
will equate to blood.
Yeah.
So
Definitely. Definitely.
anyway, so that's where things stand, and this is it's the way things go. As is what it's. I prefer that it wasn't, but you know,
Yeah.
yeah, fight Mother Nature.
Yeah.
So
Was that the bad news part?
that was the bad news part.
Okay. I was hoping there wasn't worse
Yeah,
news.
no, so nothing tragic, but just
Yeah.
disease progression.
Yeah. Yeah.
Anyway, so earlier today, I'm like, what do you really want to talk about? I don't know. I didn't have anything particularly meaningful
Yeah.
that I
No,
thought to
no,
talk about, and
no.
you brought up an interesting topic.
Yeah, well, that's one way back from episode 2 that we when we talked about your livelihood and sort of how you came into it and how you think about it. One of the topics, one of the paths not taken, then was the topic of behavioral finance, which is, to paraphrase what we were saying, it's kind of like how human emotion sort of comes into the ob- ostensibly the rational decision making process and affects how you're making decisions as it relates to money. I'm sure you have a ton of experience and anecdotes and perspective on that topic. So if that's one you'd like to explore, I bet our
Yeah,
audience.
well, it's a topic I spent a lot of time thinking about and reading about as a person responsible for investing money.
Sure.
And it was also something I talked to clients about as it relates to not only how I think about these things, but trying to help them think about these topics too.
Yeah.
And behavioral finance is essentially a subcategory of human psychology,
Hmm.
or psychology and human psychology.
Right.
And it's a study of how human psychology affects individuals' financial behavior or financial decision making. And there are, you know, categories of behavioral finance that each have sort of specific examples. But it's essentially, you know, this guy Burton Malkiel wrote a book in the 70s called A Random Walk Down Wall Street. And this was before behavioral finance was even a thing. And his thesis was, markets behave rationally, and you should always assume that they behave rationally.
Hmm.
And the reality is that's not true. And these behaviors, I mean, they're human behaviors, so they affect professional investors as much as they affect, individuals.
Hmm.
And that like some examples would be like, so an obvious one to people would be the concept of anchoring. And so people will, you know, I bought my house for X, so I'm not willing to sell it for less than X.
Right. Right.
Right? I'm anchored to whatever price I paid.
Hmm.
Or I bought this stock at 50 and it's now at 38 or 40 or something. And well, I'll sell it when it gets back to break even.
Right.
And I didn't have a lot, but I had a handful of clients that were like that. And I would, in a gentle way say, listen, the market doesn't care what we paid for our stock. The market is the price of the stock is what somebody's willing to pay you for it. The price of your house is worth what somebody's willing to pay you for it, and being anchored to a price is irrelevant.
Right.
So I think that can resonate with all of us.
Hmm.
And as I say this, I thought about these concepts in terms of my day to day behavior, trying to check: am I letting any of these inherent human biases affect decisions that I'm making? Um, Certainly, a big one that pertains to investing, but I'll give a non-investing example also. But from an investing standpoint, confirmation bias, which sounds like some fancy term. Confirmation bias means I'm going to look for information that supports my point of view, and I'm going to avoid information that counters my point of view.
Yeah.
And so, like a common thing that I and our team would think about is uh, when we're either interested in buying something or we're holding something that may be faltering or may have gone up a lot. Let's find all the research out there that tells us we're wrong.
Yeah.
Tell me why I'm wrong, and then listen to you know people make the argument. And
So
like
embrace the opposite. Embrace the
it's the opposite.
confirming
Yeah,
a
I mean,
point.
obviously, you want to pay attention to
Well,
why
sure.
your thesis is still valid,
Uh-huh.
but a good way to do that is to have people tell you why you're wrong.
Right. Right.
Um, but the media and certainly social media, like that's their
It's
business model.
architected around confirmation. Like
Right?
they've monetized confirmation
Yeah,
bias. Yes.
like people, this is it simplifies it, but it's like you're either a MSNBC watcher or you're a Fox News watcher,
Mm-hmm.
and there's not a lot of crossover in that population, except for people who, like I, for example, on bigger news days, because I'm more of an MSNBC and a CNN guy than I am a Fox guy, but I will switch over to Fox, and Lynn will yell at me. I won't switch over for long, but I want to hear what they're saying
Right.
more because I want to hear what kind of spin, what kind of BS they're putting
Mm-hmm.
on the story.
Mm-hmm.
Um, Obviously, Instagram and Facebook, they're tracking what you click on and saying, "Oh, they like this," and you hear YouTube, and they're going to send you down a rabbit hole of these topics,
Mm-hmm.
which is sort of a form of confirmation bias.
Absolutely.
Um, Overconfidence is another one. uh, I'm smarter than everybody else, or I
Right.
have insights that other people don't have. Now, there are Warren Buffett. If he suffers from overconfidence, I don't think he does, but you know, I'd say that's warranted because
Yeah. He's earned it.
guy like doubled the S&P on an annual basis for 40 years.
Right.
Um, but it's a lot of I'm I'm better than the other guy. These people don't know what they're talking about.
Right.
That's a
I'll
little less,
succeed where they are failing, or I won't
yeah,
make those mistakes.
that's a little less common. Um, Crowd behavior.
Mm-hmm.
Uh, so big market sell-offs have more to do with crowd behavior than they have to do with, wow, the market had massively mispriced risk assets, from one day to the next.
Mm-hmm.
Um, Classic example of that, I think, was when COVID hit. March 15th, stuff started shutting down,
Mm-hmm.
and the S&P 500 went down. I don't remember what the actual sell-off was, but I don't know, 15%, 18%, something like that. And then did a V-shaped recovery. And that's, more times than not in periods like that from an investing standpoint, your best bet is to do nothing.
Right.
And in this particular case, we did very little. We did a little bit of selling like in February. We happened to have a really good uh, health analyst who was on top of like what was happening and how this was going to spread and
Mm-hmm.
you know closing borders. Viruses don't care about borders, for example, and
Right.
um, obviously the lack of any type of um, antiviral. Um, but the people what people weren't considering is that the government was going to have to provide massive amounts of fiscal stimulus, which is really good for risk assets.
Right.
And so then people started crowding in that direction. That's when you see a V like that. uh, a pretty good example.
What can you elaborate on a risk asset? So what are risk assets and
Oh,
how are they
risk
distinct?
assets are, uh, X stock. Equities are certainly risk assets. Um,
So anything with volatility?
Anything that has value and has no, is reliant on the um, revenue and income streams that that asset can produce.
Got it.
Right. So companies produce earnings that they either reinvest in the business or pay out in the form of dividends. Whereas if you own fixed income, that's a loan, and you have a lien on the assets of whoever you loan the money to. Right. A bank loans money to a homeowner. Um, if they don't pay their mortgage, they're going to
Yeah.
take over the house.
Right.
Right. So you wouldn't consider fixed income a risk asset.
Got it. Got it.
So, in I guess in simple terms, you could just break it down to anything that has price volatility.
Mm-hmm. Mm-hmm.
And it's not that fixed income doesn't have price volatility, but you do have recourse.
Right. Right.
Um,
Right. The downside isn't zero.
yeah, the downside isn't zero. Um, I think
Yeah. So
those sort of cover um, the main topics of like the key concepts. I think anchoring, confirmation bias. Um, I guess anchoring and loss aversion are linked to each other.
sure.
And that's the old I bought it at 40 and it's at 38.
Right.
Losing $12 feels a lot worse than making $12.
Right. Right.
Um, which is it just does. and
Emotionally. Yeah.
and
Yeah.
and it affects professional invest. That's why they're good money managers, and there are money managers who are managing big piles of money who aren't that good from a behavioral finance standpoint. Um, So, like for individuals, sort of automate your investing. Dollar cost average, or putting obviously investing in your 401k or whatever retirement plan you might have available to you. You're putting a steady amount of money in each pay period,
Mm-hmm.
and that tends to smooth out the ups and the downs. Um, and generally speaking, people can't fully fund their 401k on their first paycheck in January, kind of thing, right?
Right.
So um, it's a fair amount of money.
Yeah. I remember discovering loss harvesting, whatever, a couple of 3 years ago, and it changed my perspective on how I feel about having something in my portfolio that is in the red, right? That hasn't done great. It's like an old version be like, "This is terrible. What a terrible
Right.
decision," you know.
Right. Why would I
Right.
mean, it's, we'd have clients who would have a loss, and certainly towards October is when we start getting around to, hey, although we're mindful of it year round, and uh, most clients just they just rely on us to do the right thing. We were managing money on a discretionary basis, for the most part. But I certainly had some conversation with clients, who wanted to hear about if we were going to take a big loss, they'd like to hear about it,
Sure.
beforehand, kind of thing. And they would, we had a few, battles where I'd say, listen, I get that it's unpleasant to take this loss. We've got $300,000 worth of realized gains this year. This is actually helpful.
Yes. Exactly.
and
Exactly.
and if we really want to own the stock, let's sell it and buy it back in 31 days.
Right.
The IRS has what's called a wash sale rule
Yes.
that says if you sell something for a loss and you buy it back within 30 days, you're not allowed to use the loss, in terms of
It cancels your ability to use the loss for tax.
for
Yeah.
tax
Yeah.
purposes.
Right.
Um,
Right.
so there are strategies to deal with that. You might own 500 shares of XYZ, and in October, double the position, wait 31 days, and sell the original 500 that's at a loss,
Mhm.
and obviously the risk there is that you own twice as many shares and you got 31 days of, if the stock goes down a lot more,
Right.
you're losing more money.
Right.
Um, Obviously, just taking the loss, the risk is the opportunity cost that between now and 31 days from now, the stock goes up a lot. So there's no particularly right answer to that. It depends on the individual's capacity to double the position. Is it assuming too much risk in that portfolio? All that sort of stuff. But having the let's take a tax loss conversation requires people understanding the concept of price anchoring and loss aversion biases
Right.
in order to get their arms around the concept.
Right. And just to be pedantic, so what we're talking about with sort of loss harvesting or the usefulness of selling something at a loss is if you want to sell something that has gained $4,000 in value, that will be taxed as capital gains, depending at different rates depending on how long you've owned it. Whereas if you I'll sell that, but also sell something that lost $4,000, it just evens out, and there are no taxes, and so it gives you a way to liquidate some of your assets and also get rid of some of the losses in your portfolio without paying any tax penalty, or at least that's how my finance
I mean,
novice brain.
that's no novice right there. That's advanced level thinking right there, Glenn, which
Excellent.
never surprises me because of your general wide range of knowledge and intellectual curiosity.
You flatter me, Pete.
But like as an example, and this is true for a lot of people, we've owned Nvidia for a very long time
Hmm.
and have obviously massive unrealized gains. And we would for stocks we had a lot of conviction and we'd get a 6, 7, 8% position, not to their overall portfolio, but to the equity exposure.
Hmm.
And when a stock goes up the way Nvidia has, that 6% turns into
Balloon.
20%.
Yeah. Yeah, you're
Now,
overexposed because they've been so successful.
yeah, and so we never let it get to be that much. But so when it gets to 14, 15, we're going to sell some.
Hmm.
And uh, in that case, and selling some for some of our clients was like, a few $100,000 would represent some.
Right.
Uh,
Right.
and that would, if you're selling $300,000 worth of a stock that's, uh, doubled, for example,
Right.
in this case, it's more than that.
Hmm.
Um, that's $150,000 capital gain. And at 20% is 30,000 bucks of,
Yep. It just goes away.
tax hit.
Hmm.
Um, yeah. No, it doesn't go away when you sell it. It goes away when you file your taxes,
Right.
right? It's
Right.
not
Fair.
withheld on the sale.
Fair. Yeah.
But in any event,
Yeah.
we're not looking to buy something that we think is going to go down, but you know, everybody, it's not possible to invest not in stocks go down.
Yep.
Uh, and so that's, I don't know, that's a further point that you were
Yeah.
commenting about
Yeah. Yeah. Yeah.
using losses to offset gains.
Hmm. Hmm. And goes back to like it gives you psychologically another place to go with this thing which you could stew on and be anchored to and want to make like, oh, if I just wait long enough then this decision won't have been so bad. There are other tools that sort of give you some freedom and let you maybe disconnect emotion from it and apply some rationality and
Yeah.
look at the silver lining of a potentially negative investment.
And like this loss aversion thing is fascinating. Like I am not a gambler. Like I've been to Las Vegas a couple times to see Dead and Co. at the Sphere.
Yeah.
And of course you go to the casino and whatever, I'd get a few $100 out of the.
What's your favorite casino game?
Well, if my buddy Adam Rhodey is with me, it's blackjack, and
Blackjack.
I have him sit next to me.
Yeah, and he'll
He
do your
know he
button.
knows all the math and
Uh-huh.
every outcome.
Yeah, that's fun.
Um, Watching craps is fun. Playing craps, you got to go big to be big,
Mm,
and you can lose a pile of money in 5 minutes. Um, but the point I'm making is, like we were going to nice casinos. It's like you're playing a blackjack hand. It's a $25 minimum,
yeah.
and like losing $25 on a blackjack hand pisses me off, and winning $25 on a blackjack hand is like, yeah, it's good.
Yeah.
So I got, and not everybody's like that, right? Some people, it's the thrill of
Yeah,
the
the
thrill of the
rush.
game, and winning makes them happy. And
Mhm.
I just, maybe it's because what I do for a living, like statistically speaking, the longer you play, the guaranteed you are to lose money,
Yeah.
right? That's the way casinos work. They're not stupid.
Yep.
Uh, and but that's a good example of I have unbelievable loss aversion at a casino.
Right.
Um, it's not as unbelievable in investing, but it's still something you got to battle.
Right. Right.
Um, so we used to. I mean, we didn't used to. We still do. And I'm now retired from the business, so I'm making it sound like it's contemporary, but I haven't been retired for long. Um, like we would set up. The example I would use is really easy to get excited about a story and buy a stock.
Yeah.
Not hard.
Yes.
Now it's hard to find to be right about it, but
Mhm.
the concept of like, wow, this is a really good story. I'm going to buy it. Um, what's not so easy to do is to know when to sell,
Mhm.
and that's where a lot of these biases come into play. Confirmation bias that I think is going to keep going up, and I'm seeking out information that tells me it's going to keep going up. Uh, you know, loss aversion. I don't want to take the loss, or um, anchoring.
Mhm.
Where if it gets back, and so we set up rules around. Uh, we set up parameters. I said if these parameters are hit, um, we're going to sell. We're selling the stock, and to try to take the emotion out of it.
Yeah. Yeah.
And even then, there
It's
are
hard.
times where the stock we'd be checking all the parameters, and then we'd still have a debate. Well, maybe this one's different, and
Right.
it's just even when you're behaving that way, it's hard to battle it.
It's a powerful force. Yeah.
But I don't know, I found it super fun to think about and to sort of just
Yeah.
frequent reality checks.
Yeah. So even being aware of it, even being an expert in the field, you're still battling it.
Still fighting it,
Yeah.
yeah,
Yeah.
because this is human behavior, not
Yes.
doesn't apply just to certain types of people. It applies to everybody.
Right. Right.
Some more so, not some people. Some of these biases more so than others,
Sure.
and some people more so than others.
Sure.
So hopefully this is a interesting topic.
Yeah.
If anybody wants to do like read up from the OG on this particular topic, Daniel Kahneman, uh, Kahneman, I think is how you spell his last name. He's sort of the OG of behavioral finance.
Kahneman. Yes,
Yeah.
that's correct.
And just as a historical note, this guy was so rational. He was like, I think he died when he was right around 90, but he went with his wife to Paris on a vacation. He was totally healthy, but he knew, like, at 90, things are going to start breaking. I don't want to experience that. And he left from his vacation in Paris and went to Switzerland to Dignitas and chose to end his life on his terms,
Wow.
which, you know, is an interesting story.
Yeah.
He, uh, he actually wrote letters to, I mean, he's a famous guy, in certain circles. And he wrote letters to a bunch of his colleagues and people that he knew well and other academics and intellectuals to be delivered after the fact to explain why he did what he did. And if you read the reasons of why he did what he did, you can say, hey, that's understandable.
I've never. This is the first I'm hearing this, and this was just last year. So he died
Yeah.
2024
Yeah.
in Switzerland. That's
So that guy took, you know, rational.
Yeah,
thinking to the extreme.
absolutely.
Said, "Hey, my cartilage wears down, your heart wears down, all of your physical abilities wear down."
Yeah, he wanted to be in control, I guess.
Yeah, and there are people with really bad diseases who have to think about these things too.
I bet.
Uh, so anyway, he was a fascinating guy. He is, I say, he's the OG of behavioral finance. So
Yeah,
anybody's interested in going a little deeper, he's your guy.
yeah. Awesome. Well, this has been great, Pete. Appreciate you sharing a little bit of your wisdom and experience on this topic, and look forward to getting into more of these in the new year with you.
Well, thank you. I think it's less wisdom and more studying from other people who had a lot of wisdom.
Okay. Okay.
So, but I appreciate it
I'll
anyway.
take the wisdom any way I can get
All
it.
right, all right, all right.
It doesn't need to be original content.
But great idea on your part for a topic. So,
Yeah.
as always, great time today, and look forward to the next one.
Yeah. I'll talk to you soon.
All right, thanks, Glenn.
If you have comments or questions for Pete and me, you can email us at 2224peter@gmail.com. If you'd like to get involved with or donate to ALS causes, check out ALS One at alsone.org. Thank you for listening.